First of all, we're going to start off with a disclaimer. Trading involves potential loss of risk of capital. It's not suitable for everyone, hopefully for you though. And many companies provide leverage, so just be aware that you can lose substantially more than your initial investment. The views, opinions, all the information that's contained in here is just solely for educational purposes. We're not trying to encourage you to trade or invest. That really has to be your decision. And of course, you should carefully consider the risks, your financial situation, definitely your level of experience and your risk appetite. And of course, you should only risk capital you're prepared, but more importantly, can afford to lose. If you have any doubts whatsoever, seek independent financial advice before risking your capital. Okay, well, what a week it was last week. Lots going on. So we saw new highs and lows broken. Uh, where do we start? The USD made a new high. The pound made a record low. Obviously, that's part of it. It's dollar strength, but also pound weakness. And we'll get into that more. But it did turn the Bank of England from a buyer of gilts, from a seller to gilts to a buyer, just to try and protect pension funds and to also calm the market. But by the end of this month, they probably will turn seller of the gilts again. Remember, gilts are just government treasuries, but in the UK, as long as the conditions will allow for that. The concerns have been around the UK government high spending with energy caps and also promising tax cuts as well. And of course, that prompted investors to basically sell the pound down to all-time lows of just over 1.03. And that's because they questioned how the UK would be paying for all of these actions. It's going to amount to probably about 200 billion. Treasuries continued to rally. That's the yields, of course, and stocks fell. Oil and gold rallied, but oil had a bit of a rangy week, to be honest with you. But they finished the week steady for sure. Central bank speakers continue to warm up on more rate hikes, and they just can't stop talking about these at the moment. And people have to take notice of these. They're not going to stop anytime soon. But we'll come up to that anyway. So Eurozone inflation hit 10%. Prices are up across the board. Italy has a new female far right wing leader. So again, just wait to see what they come out with. Whether they're going to sort of try and follow EU guidelines or not. But again, it's going to make their bonds very delicate as well, and open to again more pressure on the yields there. Ukraine continued their advance, and resistance is weakening there from the Russians. Many Russians that have been called up by Putin would rather flee the country than actually go to fight. And then, of course, we've had this situation where Russia's tried to annex the Ukraine territories after so-called referendums. The world is, well, the majority of the world has come out against that, obviously. Hurricane Ian in the US caused probably around about $65 billion worth of damage. The hurricane, then it was again. Mainly around the sort of Florida area. Now, UK GDP was positive, just 0.02%. And as I mentioned before, Bank of England had to reverse from a seller of gilts where they're trying to unwind the balance sheet to a buyer. They bought about £1 billion worth, but they're prepared to buy a lot more if they need to help protect pension funds. China data improved slightly. House market remains under pressure, obviously, with all these rate hikes that are going on. And in the US, the PCE, which is very, very keenly monitored by the Fed, dropped from 6.4 to 6.2. It's become sticky around those sort of levels at the moment, I would say, for the last few months. And, with Q3 just ended, it's going to be really interesting to see that GDP data is released from countries looking at Q3. So the data this week is a little bit light, except for manufacturing and, of course, NFP on Friday. The latter is looking at probably round about 200,000 jobs created. I expect earnings to increase again. Watch for the hours worked. Those areas I'm more focused on than the actual job numbers these days, just because of where we are there. And there's not much else to come out, to be honest with you. It's PMI, manufacturing across the board. The EU has retail sales as well, so that may be worth taking an extra look at. And if going into Asia, they've got trade data, they've also got inflation data along with their PMI. So there's not much to say about this week, but obviously it's going to all be this build up towards the end of the week for the NFP. However, there are lots of Fed speakers and other central bank speakers this week. So, of course, that is something to just keep an eye out and an ear out for, because, if they keep continuing to emphasize these rate hikes, hopefully everyone is taking note of that, because there's more pain to come for sure. I suppose on the good side is the fact that if you've got extra cash, you're actually going to earn some interest on it. And wow, it's been over a decade since we could say that. Now, moving on to the macro outlook, what do we expect? Inflation, of course, it's still there. It's not going away anytime soon. It seems to be getting stickier and stickier. Not so much a surprise, but you would expect it to start coming down. You would expect consumers to start, being more reserved with their buying and buying more of what they need rather than what they want. But inflation's not coming down anytime soon, which again is making it more difficult for the central banks. Stagflation is around. Stagflation is inflation without growth, and expect to see more of that, I would say. And then leading on to that, obviously, is the recession. Now, I personally believe that the central banks will drive the economies into recession, create an economic reset, if you like. And the reason for that is because it's the only way they stand a chance of getting control of inflation again. So again, just bear in mind, they're going to put rates up more. And not only that, but into next year, not just short term, but into next year, I believe that they will keep rates up higher, because they're going to want to see 3 to 6 months at least of getting that inflation down, and it's sticking around their desired 2% level. And until it does that, I would not expect to see rates cut. Obviously, if something major happens with Russia or COVID, then yeah, potential's there. But otherwise, probably not. Supply chain issues are there, but not as deeply. Again, all eyes are on China with the lockdowns. At one stage, there was over 20 cities, but I think they're being slowly released now. But they do have this zero COVID policy. Russia's invasion of Ukraine, as I mentioned, is not going to plan. Ukraine are fighting back. They've regained ground, which is great. And you read the reports, some of the Russian soldiers are even just retreating. They just don't want to fight. And of course, as I say, Putin tried to call up another 300,000, which when you think about that, he's admitting he's not doing well in the war if he's calling up all these extra 300,000 to go and fight. But of course, a lot would rather leave the country than fight. So there's, flights are actually at a massive premium where people are trying to get out of the country at the moment. Moving on to energy, it's sort of it's become a little bit more stable, but of course, as we know, there was problems with the pipeline from Russia into Germany. Uh, again, what caused that? Uh, was it natural or was it sabotage? Lots and lots of conjecture on that. And oil sort of stayed around a range, not going too far either way. Gas prices did surge again on that though. Now food inflation, it has settled. Uh, Now inflation for me is it's uh, if you look at PPI, I would expect that to start to come down because the cost of raw materials has come down. Energy, oil and gas and everything. Okay, they're still high, but they're well off their all-time highs that we've seen in recent months. So you would expect to see PPI coming down because producers are paying less. However, I think what they're doing is they're holding on to those profits. They was already getting a record 15% in the last decade or so on of revenue profits for their bottom line. But I think that the greed factors come into them at the moment, and they're just not passing on any savings to us, the consumer. So I think you're going to see PPI coming down, but you're going to see CPI staying up. And I think for me, they're trying to maximise their profits before they see that potential destruction of demand coming in from the recession and all these rate hikes, which is going to force them to drop prices and depending on the sector they're in, some of them probably quite aggressively, others less so. And of course, we're still seeing that lack of workers, as I say almost every week, just surprises me, but it is. And you'd think at the moment, with the way the value of everything's coming down, apart from obviously inflation, that, asset-wise I'm talking now, that people would actually be looking for work. They would be keen to get into work and establish themselves before these jobs suddenly evaporate. But that lack of workers is keeping earnings pressure around.